formed about the wealth management pyramid, wherein basic was protection, followed by savings, growth, and diversification, then speculation, and eventually wealth distribution. Under protection, we learned about life insurance, critical illness cover, health insurance, emergency funding, and housing insurance. So these were the highlights from our previous webinar. Now I request you, sir, to please proceed with further information related to financing. Thank you.
Hey, thank you, Niti. Just one correction there. So one formula which I would like you guys to remember is income minus savings should be the expenses. What we usually do is income minus expenses are our savings. I would like you to follow the other way around in order to establish your savings first. And then whatever is the residual from that, you create your own budget in order to allocate your expenses. That's something which I would like you to remember.
Okay.
Okay, I had one assignment for you guys last week. That's around super top of medical policy. So did anybody go through that particular policy details as to what that actually is for? Anybody? Nope.
Yes, sir, I tried, but not much I can find.
Okay, fair enough. Let me address that particular element. Give me 1 minute. Let me share my screen with you guys. Are you able to see my screen, the PPT?
Yes, sir. Yes, sir.
Okay, if you see the average treatment cost of major ailments, so we are looking at any transplant related work like liver or kidney would cost upwards of almost about ₹1 million, or lung transplant or a heart transplant would cost almost close to about 1.5 to 2.5 million. And any cancer related treatments would cost not less than 10 lakh rupees, usually in most of the cases. One of the recent case which I'm aware of is one of my client's mother-in-law who underwent the cancer surgery, and the treatment cost came out to be almost about 21 lakhs. So considering all these factors, it's important for us to take a medical insurance so that we do not dip into our savings or disturb our financial plan as such. So what happens is, if you are going for a base medical policy of about 20 lakhs or even 50 lakhs for that particular matter, because when we are looking at medical insurance, we should not be looking at the current situation. We should be looking at the situation almost about 5 to 10 years or 15 years down the line. So if you know the medical inflation, it is growing at an enormous pace of almost about 15% on an annual basis. So considering that, if you have a medical coverage of about 5 lakh rupees, you might be it might be sufficient for you at this point of time. But 10 years down the line or 15 years down the line, when you look at your 5 lakh rupees, that's going to sound very, very minimal. And if you manage to contract any ailments, then the insurance company would not be in a position or would not even increase your insurance limit. Even if you are ready to shell out money in terms of premium in order to have a higher insurance cover, insurance companies would not be underwriting those policies. So considering all those factors, it's extremely important for us to ensure that we take medical insurance as per what future has in store for us. So one of the policies which comes in very handy is a super topper policy. So I'm sure most of you have the aspirations of working with a corporate after your graduation or post-graduation. So most of these corporates would offer you a medical insurance in the range of about 3 to 5 lakh rupees, depending upon the kind of organization which you are going to be associated with. Ajay, you remember how much HP was offering? Was it 2 or 3 lakh rupees?
Initially.
Yeah.
Initially or?
Now, initial the medical coverage which was available for employee and family, I recall somewhere around 3 lakh rupees as
3 lakh,
coverage.
3 lakh, 3 lakh.
3 lakh. So nowadays, most of the organizations have increased it to about 5 lakh rupees. Now, but the situations which we have in hand would call for more amount of money to be shelled out. This is where super top-up policy comes into picture, wherein you can cover yourself for almost about 50 lakh rupees. I repeat, it is 50 lakh rupees coverage, wherein the first 5 lakh rupees is something which will have to be borne out of your pocket, or your company policy will have to pay for that 5 lakh rupees. This concept is called as a deductible. Okay. Whatever might be the treatment in a financial year or in a particular insurance year, if the first 5 lakh rupees is something which will have to be borne by you or by the company, and over and above that, for another 50 lakh rupees, you can use your super top-up policies. Now, you might be asking as to why you should be going ahead with a super top-up policy. Why not a base insurance? Now, base insurance, if you have to take for about 50 lakh rupees, for an individual who is in his early 30s with family, that's wife and 2 kids, he will have to shell out close to about 40 to 45,000 rupees of premium for a base medical coverage of almost about 50 lakhs. So the intelligent way of doing it is, you can take yourself a base policy of 5 lakh rupees or 10 lakh rupees, which might cost somewhere close to about 18 to 20,000, depending upon your age and the medical history. And then shell out the residual 10,000 rupees in order to take the super top-up policy, which will help you in saving about 20 odd thousand rupees on a monthly basis. You would have the coverage of almost about 50 plus 10 lakh rupees, that is 60 lakh. At the same time, you will not be shelling out a huge amount of premium to the tune of almost 45 to 50K. So it's a bit difficult concept. This is not something which many of your insurance agents would suggest for, because most of the insurance agents' revenue is the commission. Now they are going to earn commission when they sell policies which has higher premium amount. So instead of selling super top up, most of the people would prefer selling the base insurance policy. So that's why you might not have heard of this particular concept. I would strongly recommend you to go back and do a bit of a homework. You just go to Google or YouTube and just type on super top up medical insurance policy. You will get host of information. Please go through that, and that's a very extremely important concept which you will have to know. And Ajay asked a question last time in terms of, I was touching about the second aspect of the money management and not the first aspect. Now, how you guys can generate money is through different means. One, you can be an insurance agent for life or for general. That is, you guys will have to require your vehicles to be insured, or your family's health needs to be insured. You can be an insurance agent for that. You will have to approach an insurance company who is going to go ahead and train you for several hours. And after you are trained, you will have to pass an examination which is conducted by NSE India or NCFM, depending upon the model. And you can go ahead and take your insurance license and then be an insurance distributor. You can also be a mutual fund distributor. You will have to clear the AMFI related exam. AMFI is nothing but the body which regulates the mutual funds in India. You can also make money out of trading. That's something which I would highly recommend you not to do it until and unless you have a mentor available with you who can guide you or who can correct the mistakes which you would be doing. Speak to your parents if somebody is into trading. So you might want to ask them to teach you trading. So these are some of the ways with which you can make money. Any questions? Any questions on previous topics?
Yes. No, sir. No doubts.
Okay. Excellent. So we spoke about critical illness cover, life medical insurance, emergency funding, home insurance. Now let's start the new topics: savings, growth, and diversification. Now, most of you are aware of the concept of savings. So, if you are keeping your money under your pillow or in the piggy bank, it's not going to earn you any money. So, what you will have to do is whatever money which you are saving, that has to go into your SB account or savings bank or fixed deposit account, where this idle money start generating cash for yourself. Something is better than nothing. It might be earning you hardly about 3.5 to 4%, and in some cases, like IndusInd Bank or Bandhan Bank, might be offering you a higher rate of interest of almost about 6 to 7%. But the key here is you are not supposed to keep it idle. You are supposed to employ or deploy your money in order to make returns. One question which I have for you guys. What is the deposit linked insurance scheme got to do with the savings which you are savings or the FD which you are keeping with the banks? Has anyone heard of insurance on your deposits with banks?
Sir, it is the insurance to protect our money from the bank. Like if bank fails to provide us the money back, then
Yeah,
the insurance comes into hand.
very much true. If the bank goes bankrupt, in that case, the deposit linked insurance scheme would come into the play, and it is going to reimburse you about how much? Do you know the limit? The maximum limit?
No, sir.
It's 5 lakh rupees. So any amount which is kept below 5 lakh rupees along with the interest accrued is going to be secured by the deposit linked insurance scheme. So your savings are absolutely safe, but anything over and above 5 lakh rupees in any mode for that matter, whether you keep 5 lakh rupees in SB and then 5 lakh rupees in FD. So the scheme is going to cover you or protect you only to the extent of 5 lakh rupees. And if the bank goes belly up or bankrupt, you are not going to get the residual money back. It's limited to the extent of 5 lakh only. Mutual fund sahi hai. Heard of this particular campaign? You might have seen, if somebody has the habit of watching CNBC or any other business news channels, you would have heard about it every now and then. Can somebody just tell me in simple words what mutual funds are all about? Come on, let's make it more interactive. Let's not let it not be a monologue.
Guys, you might have seen in the television also in many advertisement about mutual funds.
Yes, sir. There is no exact idea regarding that, sir.
It's okay. Just coin out your idea, whatever you have in mind. It's fine.
We invest regularly in mutual funds and then we gain a profit out of it. Yes, sir.
Okay. Any other idea?
It is that a company where it collects money from many investors, and the company itself invests in the securities.
Very good. Very nice attempt. Anybody else?
We invest, the mutual funds company invest for us in the securities, but at the same time, we also earn profit, they also earn some profit from our money.
Okay, fair enough. Everyone is there in order to make money for themselves as well as for others. If I'm not making money, then why should I be doing that work? Right. Fair enough. That's a fair answer. Let me put everything together. Now, let's assume retail investors are like you and me, who would have about 5 to 10,000 or 15 to 20, whatever amount which we can spare on a monthly basis, that is available with us for the investment purpose. Now, stocks. Now, NSE and BSE are the prominent exchanges where you can go ahead and buy the shares of the companies like Reliance Industries. Many of you would be using Geo network for your classes and for your 4G say internet connections. So that's a company which is listed on the NSE and BSE platform, wherein you can be a part owner of that particular company. Everybody with me so far?
Yes, sir.
Now, Geo, yes, we are aware of it, but have you heard of Dixon Technologies? Anybody heard of Dixon Technologies name?
No, sir.
No, sir.
Mobile phones which you guys use, or the TVs which are being branded as Samsung, LG and all, they are actually contract manufacturing, which are manufactured by Dixon Technologies, and Samsung will actually brand it based on their technology, and they will sell it in the open market. So even though what you see is Samsung, which is the actual seller and the owner of that particular technology, but the manufacturing activity is outsourced to a company called Dixon. Now, what mutual fund or fund managers do is they identify stocks, the hidden companies or the companies which you and me as a normal public might not be aware of. They will go ahead, dig it, they will understand their business structure, they will understand their financials, they understand what the future plans of the management is, they evaluate the integrity of the management in order to understand if what they are doing is what they are saying, and do they have sufficient skin in the game. That means, do they have, are they, for example, if you are owning a business, when what I mean by skin in the game is, if you own a business, you are going to make every effort in order to ensure that the business succeeds. Most of the companies, promoters have very minimal shareholding of that particular company which they are managing. When they have no literal legal interest or vested interest in that company, they are not bothered about the success or the failure of the organization. They are running it for the sake of running it. So all those factors are something which the mutual fund managers would analyze it, and they will chalk out a portfolio of about 40 to 50 or 10 to 15, depending upon the schemes. We have almost about 44 mutual fund companies, AMC's asset management companies in India, and they run hundreds of schemes when getting into equity as well as debt. So find an advisor for yourself who can help you in bridging the gap between what you need and what the mutual fund managers have to offer for you. So they are going to be investing your money in these companies, and as and when the stock value increases, or as and when you start receiving the dividends on the stocks which are being held by the mutual fund companies, there is a concept called NAV, net asset value. Any new mutual fund which comes out with, they come out with a net asset value of 10 rupees. If you have invested 10,000 rupees, the NAV of 10 each, then you are going to get almost about 1,000 units of a mutual fund. That's the basic concept which you will have to remember. In mutual funds, it's the units which matter, and what is the NAV at which you have purchased those units. These are the two things which you will have to remember. Now, on top of it, on a daily basis, they publish as and when the market fluctuates. Yesterday, if you have seen the market went up by almost about 0.5 to 0.6%. And at one point of time, it was almost at 0.8%. Now, if you see the actual mutual funds value at the end of the day, it would also increase simultaneously. Might be proportionally or might not be proportionally, depending upon the composition of the stocks which a mutual fund has. But on a daily basis, depending upon the stock market performance, your mutual fund NAV will also either raise or they will fall. This is something which you can track from the AMFI side, AMFI. Just go to AMFI and then look at the NAVs. You will be able to find it. Now, this is the most secure and the reasonable way of building your wealth, wherein you give it out to a professional who can manage that fund for yourself, and you get on with your regular activities. Because if you are investing in the companies directly by yourself, that means you are competing against professional fund managers. Now, professional fund managers have their own research team. They have their own resources with which they can gather intel. But you and me as a retail investor, we will not be able to get this piece of information, and we will always be at a disadvantageous position in comparison with the fund managers. So mutual funds, as the statement itself says, sahi hai, it's the most appropriate way for creating wealth for yourself. Stocks which we spoke of, you guys have already read about primary market and secondary market in your studies, right? All the commerce students. Primary market being the IPO market, and secondary market is where actually you and me can exchange stocks. You can buy or you can sell, I can buy or I can sell by listing my price. Stock investing is one of the most tedious way of doing an investment, wherein you will have to put a lot of energy as well as focus if you're doing it yourself. That's something for the time being is a avoid. Get into start with mutual funds, and then over a period of time, once you expand your knowledge base, then you can get into stocks. Bonds is nothing but the debt side of the companies. Companies would not only be raising equity share capital, you also know that companies might be issuing debentures also, fixed deposits also. In this case, so shares would have the ownership of the company, whereas when it comes to bonds, bond becomes a liability for the company, wherein they will say, okay, on an yearly basis, I'm going to be paying about 7.5 or 8% annually. This is the interest rate with which I am borrowing from you guys, from the public or from the mutual fund companies, whatever the case is. Now, bonds, during the time of liquidation, I'm sure it's a first or second year PUC related question. During the time of liquidation, who gets the first right on the assets of the company? Is it the bondholders or the equity shareholders?
Bondholders.
Equity
Bondholders,
shareholders.
right? Equity shareholders, are you sure?
No.
It's always the bondholders, because bonds are a liability. Both of them are liability because company is a different entity, but bonds have got higher weightage when it comes to the liquidation. First criteria for the company to liquidate or go the first steps which they will have to look at is, what is my bonds or the debenture liability? I will have to ensure that that is paid off before even I go to the equity shareholders. As a equity shareholders, you are taking limited liability to the extent of the money which you have put in. If after settling all the debenture holders, employees and creditors, if there is nothing left, then equity shareholders cannot demand any money from the company because they are the company at the end of the day. If something is left after settling all these liabilities, only then shareholders would be entitled to receive anything. From whatever I have seen so far during the some of the liquidation process, shareholders will have to forget about whatever their holdings are, because it's usually the creditors who would take away the cake. Now, who would be opting for bonds is individuals who would be looking forward for fixed returns on an yearly basis. Those who are approaching retirement, who cannot take excess risk of investing in equity market via mutual funds or with stocks. They are the ones who would be looking at the bonds or the debt market. This is one of my favorite, exchange traded funds. Heard of this particular concept? Nowadays, it's gaining extreme high momentum. Heard of this exchange traded funds?
No, sir.
No? Nobody?
No, sir.
No, sir.
How many of you like gold?
Many, sir.
And none of the girls are speaking out. Okay. See, what are the problems associated with?
Instead of that, we can ask them who don't like gold.
Then I won't get any answer, Ajay. Interesting. So, what are the practical complications associated with purchasing and keeping gold?
No return, so it's just kept as like some ideally keeping it somewhere.
It's
Agree,
always
agree.
increasing in its value, sir. It's kind of security.
Okay, fair enough. Now, when you speak about the capital appreciation, are you speaking about the jewelry side of it or the coin side of it?
The coin side of it is better, sir.
Okay.
Coin side of it, sir.
Okay. What is the practical complications associated with coins?
I don't know about that.
Security,
Yeah, yes, sir.
the chances of theft, isn't it? So what are the practical issues associated with it? You might end up losing out that particular money if there is a theft or a burglary or robbery at your place.
Even jewelry, the same, sir.
Yeah, agree. You might have heard of hundreds of cases of chain snatching in and around your areas itself. So goes with everything, whether it's jewelry or the coins, anything for that particular matter. Security is a primary risk when it comes to gold, which is kept in the physical form. So what you can do is, if you are looking at gold as an investment and not from an ornamental or aesthetic purpose, then you can look at purchasing a concept called gold bees, BEES. Now, this is an ETF. How it works is, there will be an asset management company, let's say Goldman Sachs, who will be purchasing 1 ton of gold on your behalf. They will be keeping it in their security deposits, in their safety lockers. Against that 1 ton of gold, they are going to be issuing gold bees in the exchange, NSE or BSE. They will say that one gold bee would be equivalent to about 100 rupees or 150 rupees, whatever the value they're going to assign. You and me, as a retail investor, we can invest in gold with as less as 100 rupees. We can go on accumulating this gold over a period of time, and the value of this particular gold would appreciate in line with the value of gold which is going ahead in the market itself. If in 2008 or 10 the market value of gold was about 1,500 odd rupees, now it's trading around 4,750. So whatever appreciation which you have on physical gold, the same kind of appreciation you are going to get, same percentage of appreciation you are going to get in gold bees as well. Now the advantage is, it is completely safe. All these gold bees which would be purchasing from NSE will be kept in your dematerialized account. Heard of demat concept?
Yes, sir.
Yes, sir.
So demat accounts are where all your shares are saved in an electronic format. The same applies for gold bees as well. Whatever amount of gold which you're going to be purchasing, that will be kept in the electronic form in your own demat account. So the probability of theft is almost eliminated. It's next to nil. And it would gain the same kind of capital appreciation which the market gold would have. No jewelry making charges, no wastage charges. So these are some of the, in similar lines, there are other funds also which caters to other instruments. Okay, so these are ETFs. These are the passive way of making investments. So something which you might want to further explore on. Any questions in this particular slide?
No, sir.
Okay. Okay, next, moving on to the speculation market, we have derivatives. So you would have heard of F&O market in your syllabus, the derivatives market, where you would get a leveraged position by, instead of purchasing shares worth of 5 lakh rupees By paying upfront capital of 5 lakh rupees, you can take the same position by paying hardly about 50 to 60,000 rupees, 10 to 15% basically of whatever the contract value is. It's not for the newbies. It's purely for professionals in order to hedge their position or for speculating. This is something which you should not be touching it in your initial at least about 5 to 6 years of investment in the market. You will have to gain knowledge, experience, only then get into this. Forex, the foreign exchange business, the USD versus INR or USD versus GBP, whatever the foreign currency markets are. So if you are into export or import or export business, now any major fluctuation, for example, rupee at one point of time was trading at close to about 60 rupees. Now it is trading at about 74 rupees. Now let's assume I am an importer. Okay. I got into an import contract, say for buying close to about 1 crore worth of products from US. Now, at that point of time, the USD to INR value was close to, let's assume, 65 rupees. Now, in about 2 to 3 months, because of any condition for that particular matter, it might be geopolitical or it might be the financial condition of the country might have collapsed, because of which, if the USD INR rate has changed from around 65 to 70 rupees, in that particular case, the importer will have to pay 5 rupees extra
Today
for
it's
the
72,
import.
sir.
Yeah, now it is at 72. I'm just taking an example. So if it is 60, it has increased from 65 to 70, 5 rupees is going to be the loss which he is going to incur on every import which he will be making. That's going to blow a big hole in his pocket and make his business an extremely unstable business. So in order to mitigate the risks, when he is entering into a contract with a US company in order to take that import contract of worth about 1 crore rupees, he will also get into a foreign exchange contract wherein he will take certain option contracts which will freeze, which will give him the right to buy dollar at 65 rupees only. He might have to shell out some amount of premium, which we call as insurance in layman terms, but that's a kind of insurance which he will have to take in order to ensure that even if rupee fluctuates in the future enormously, his business is not impacted. Foreign exchange markets are primarily used by importers and exporters in order to minimize the impact of fluctuation in currency values on their business. Now, one quick question for you guys. Most of you might be aspiring to work with TCS, HP, JP Morgan, or any such organizations which are providing the outsourcing solutions from their India branch to their US branch. Now, in this particular case, what situation favors these organizations? Is it rupee depreciating or rupee appreciating? What is the most favorable situation which the exporters would have? When rupee depreciates or when it appreciates?
I guess it's appreciating.
Any other answer? When rupee is appreciating, that means today's value is 72 rupees. So that will go down to 71 rupees. They will get less. The contract is going to remain the same. USD 150,000 is going to be the contract. But rupee appreciates. In that case, it becomes 1 lakh contract, 1 lakh USD contract would fetch them, instead of 72 lakh rupees, it is going to fetch them 71 lakh rupees as revenue. So that's not a favorable situation for the exporters. For exporters, it's always a rupee depreciation which works in their favor. For importers, it's the other way around. Any questions?
No, sir.
No, sir.
Commodity market, you might have heard of crude oil trades or silver, gold. or even agricultural products like corn and other things. These are also traded in commodities. I'm no expert in commodities market, so I'm staying away from it. So this is something which you will have to explore on your own. And the last one is the real estate. So this is something which most of us would have exposure to in our families. So anybody who is looking at a speculative investment will actually go for can go for real estate also. But most of Indians have majority of their net worth associated with real estate, which is not extremely liquid in nature. And also the rate of appreciation is around 7 to 8% over a period of time. In comparison to that, equity easily beats it by almost about 3 to 4%, considering the past 20 to 25 years of Indian market records. And if you were to take the US records, almost about 95 to 100 years, equity has always beaten down real estate. The last stage of my wealth pyramid is the estate planning and the succession planning. Anybody has any idea as to what this concept of estate planning and succession planning is all about?
No, sir.
In the
Sir,
movies,
succession planning is basically the assets which we make for our next generation, coming generation.
yeah.
And estate planning is the house and assets that we build from our own side.
And both of them are one and the same, no?
Sir, estate planning is how they preserve, how they try to manage their assets, individual
Okay.
assets.
Yeah. And succession planning?
How much you want to give to your successors?
Not really. Okay, let me. It's a bit of a difficult concept. I would not have expected anybody to answer this right. Estate planning is nothing but you would have seen in the movies the wills. So an healthy or a rich individual would have created a will and he would distribute his assets amongst his legal heirs. So that is nothing but estate planning. So all your assets, financial assets or real estate, whatever it is available, you distribute it amongst your legal heirs through will. That is called as estate planning. Now, succession planning is a bit different and it's mostly associated with people who are actually into business. Now, for employees, this is not applicable. But for people who are into business, it plays a vital role. Now, today I am into the say world of financial planning. So what happens to my clients and to my business if I'm not around tomorrow? I need to create that next line of next planning as to who is going to take over my business. Are they sufficiently qualified in order to manage it? All these plans, training, and succession related activities via the legal papers, all these clubbed together is what we call as succession planning. You would have seen the major case of Ambani's, right? As to how the business empire got split into two. That's because of lack of succession planning. Okay, I am income tax. Have you read this particular concept? So by the way, before that, any questions in the wealth management pyramid? Anything which you guys have? I have only touched upon the basics here. So you guys will have to make an effort in order to go in detail in order to understand these concepts. And if you are not clear of any of these concepts, you can always reach out to your teachers or you can reach out to me in order to seek more clarification. So I have just given you guys the hint of What are the things which we will have to look at, but not the in detailed study associated with it. Okay, coming to income tax. So, in one of the famous books of European, economics, there was this particular statement: the only certain things in life are death and taxes. You cannot avoid both of them, whether it is direct or indirect. So as far as direct taxes are concerned, if some of you who are in your final year of graduation would have already seen this. Some of you who are in your first and second year might not have seen it, but there are direct and indirect ways of taxation. Direct is when they collect it from the ways of income tax, and indirect is when they will put it in the form of GSTs or the sales tax and other stuff, which actually passes on to us in terms of the MRP, which we pay the price for. Whether it's laptop, electronics, any consumer goods, everything and anything and everything would have these elements in it. Now, this I would skip it for the time being. Okay, this is something which is a bit advanced and primarily useful for the employees who people who have already started working. So if you have not learned this particular concept, you can skip it for the time being. But if you are in your final year of graduation, then you might want to explore on these concepts because these are already discussed in your textbooks. The reason why I skipped it is I wanted to spend more time on inflation. Can somebody tell me what inflation is all about? Basic concept of economics. No hi-fi funda here.
The rise in the prices of goods and services of daily products.
Yeah.
So, for example, like today we have asset value of rupees 100. Like over a period of 10 years, the asset value increases, the same asset value increases to about 1,000 rupees. So the percentage of increase is the inflation rate.
Okay, capital appreciation masked in terms of inflation. Okay, we can say that, yes. And during our college days, that is, I'm speaking about me and Ajay, yeah. So we used to have tea at an expense of about 1 or 1.5 rupees. So now the same tea costs somewhere close to about 6 or 7 or 8 odd rupees or 10 rupees in fact. So the increase in the price of our normal daily consumables and a decrease in the value of the rupee or the currency with which we are purchasing it, that is the concept of inflation. Over a period of time, our money is going to lose out on its value. So anybody who is keeping the money underneath in the cupboard or underneath or in your piggy banks, do not think that your money is safe. Your money is losing its value. If you're not employing your money in order to make more money, that means the money which you have kept with you, that is depreciating in a value. You can buy less and less of things as the time progresses. So it's always important for you to ensure that the money which you're deploying and it takes care of the inflation aspects of it. For example, if you're planning for a retirement concept, a retirement individual who is already in his 60s or entering the late 50s and planning for retirement, he will always look out for avenues where you might want to park 1 crore or 2 crore rupees of his savings in an instrument which can give returns which surpasses the average inflation rate of that particular country. If the returns are not beating the inflation, that means he is going to be in a disadvantageous position in the future because the amount of money which he has saved would not be sufficient to last through the lifetime. And he will have to either start working or depend upon his kids or relatives in order to maintain himself. I want you guys to fill this particular answers. What is the consumer inflation rate in India? Average. Let's not be ballpark, but somewhere around average.
6%.
Medical inflation. I gave the answers earlier during my lecture.
15%.
Yep, around 15%. Education. Education.
4.46%.
You missed it by a long shot. It's close to 10%. Yes. Unfortunately, that's the scenario. And our lifestyle inflation, now, let's assume an individual starts with a salary of about 15K. Now, as and when his salary increases, what you would usually observe, an individual who would be traveling in a normal, say, bike, if the salary increases from 15K and to, let's say, about 60 or 70K in the future, so his lifestyle related expenses would also increase proportionally. So lifestyle inflation is always in sync with income. It's an exception for very few individuals, but barring those few individuals, it's always the same. So instead of me going to Shantisagar in order to eat food, I will venture out to Meghna in order to have biryani. Agree, disagree? So for lunch, if we were earning 15,000, so I would think about spending about 60, 70 rupees in a meals in a Shantisagar. But if you are earning about 50 to 60,000 rupees, and if you are hungry, you will look out for a Meghna or a Nandana in order to have your meals. You will shell out close to about 2 to 3 times more than what you would have had. So this is nothing but the lifestyle inflation which we are speaking about. So I have just plotted the consumer price index from 2000 to 2018. At one point of time back in 2000, between 2010 and 2012 or 13, in fact, India as a whole experienced huge amount of inflation, which was in double digits. And that's something which is extremely detrimental for any economy, whether it's India, US, or anything. By the way, anybody knows the inflation rate of US? Take a wild guess. It's a developed economy. So think in those lines. What's the inflation of US?
2 to 3%.
A little bit less, between 1 to 1.5%. So considering that, so we were extremely high, and whose objective it is in India to manage inflation? Which is that particular entity which manages inflation? Or not
RBI.
manages, which tries to control? Yes, RBI. RBI, through its liquidity measures, it will do every possible bit in order to keep inflation below 4%. But as of now, it's hovering over and above that, thanks to the scarcity of goods and services due to the COVID scenario. But otherwise, we were comfortably well within that particular target range. Any questions associated with inflation? If no, I'm going to move to this next important aspect of investor behavior. Now, let's take two investors into example. Okay, both have started their job. Both of them are earning about 15 to 20K on a monthly basis. And both of them, considering they are still living with their families and they do not have a wife or kid in order to manage. So both of them would be saving close to about 10,000 rupees on a monthly basis. If you are saving close to about 10,000 rupees, both of them, okay, individual A, individual B, they would be going ahead and purchasing mutual funds. Let's assume they are taking the same mutual funds. Example, Mirae Asset Large Cap, which invests in the top 100 companies of India. So they are going to invest in Mirae Asset Large Cap. over a period of about 5 years, if you look at the returns which both of these individuals would have generated, you would see that everything remained the same. Money inflow remained the same. The scheme which they have invested remained the same. But the returns which the individuals have got would be different. Now, the reason for that would be, now, as and when he starts tracking the market, so he might get emotionally carried away in order to make more investments at certain point of time, or withdraw certain investment. For example, if you look at it today, as of yesterday, in fact, market is trading at its peak. It's closed at its almost like close to the all-time highs in Nifty. Now, an investor A might be too afraid, stating that the markets might collapse from here and he might liquidate his investment. Whereas investor B might be looking at, I'm not in need of this particular money for the next about 5 to 6 years. So it doesn't matter whether I withdraw or let this particular money stay in the market. So he is going to let this money stay invested in the market. So the emotional behavior of these two individuals is what drives this particular behavior gap, the investor return gap, because of the behavior of that particular individual. So this is extremely important, and this is the reason as to why we always recommend individuals to start taking professional help, which is either a financial planner or go to your mutual fund advisor who can help you out in riding the tide. For example, when the COVID situation hit us for the first time back in 2020, March 2020, the Nifty or the NSE market fell from almost 11,500 to 7,500 within a matter of few weeks. That's a dip of almost about 35 to 40% in a matter of 3 to 4 weeks. Now, individuals who are scared, I know quite a lot of my clients who did not invest at that point of time, in spite of our advice stating that go ahead and you are getting it at dirt cheap price, go ahead and grab certain mutual funds. They did not invest because their friends and family were the opinion that the market is going to go to 5,000 or 4,000 in fact. So they never invested. And when the market actually started picking it up and it reached around 9,000, they were like, okay, I have already lost it. So I'm going to wait for some more time before entering. And the market never gave them an opportunity to make a re-entry. And it in just 1 year, that is from last April to this particular April, May, if you have seen, market has moved up by almost 100% from 7,500 levels to 14,500 levels as of Friday. So almost about 90% jump. So most of them have never got an opportunity. And those who actually invested back in March and April via the advisors of the financial planners or the mutual fund distributors, they're sitting on good amount of money. So that's why we always tell, so always seek a professional help. Do it yourself. That is the DIY concept. Might not always work. It can easily be replaced with do the damage yourself. Seek a professional help when it comes to investment. The last topic, I believe, for today. Oh no, there is one more. So, any question with respect to the investor behaviors?
No, sir.
How many of you have heard of credit score?
Yes, sir. I've heard, sir.
What is it used for?
To calculate civil score.
Oh, excellent. Awesome. You gave the right or the direct answer. What is CIBIL?
I don't know, sir.
Okay. So it's an agency or an organization which actually evaluates the credit worthiness of an individual. Now, we have CRISIL. You have heard of CRISIL, right? No? Yes?
No, sir.
Nobody has the habit of reading Economic Times?
Uh,
Please cultivate one. That's a good habit to have. So CRISIL is an organization which actually credit or rates organizations, companies on their credit worthiness. Are they good enough in order to meet the liabilities which they have taken on themselves? So they evaluate their financial strength and based on their existing financial books as well as their future plans. Now, that's as far as an organization is concerned. Now, for individuals like you and me, okay, so when we start working with an organization, so we would like to purchase two-wheelers, or we might want to purchase car, or purchase a property, or a real, or a flat, or anything. Now, what is the basis with which banks would be in a position to lend money to us? They would not know us personally. they they just know us because of our transactional relationship which we have with them. They don't know our complete financial position because I might have just an SB account with them. I might have my credit card and loans with somebody else. So this CIBIL collates all your financial transactions which you do using your PAN number into one particular place. If you have a credit card and if you're taking if you're using credit cards in order to purchase, then it tracks, okay, you have purchased about or you have utilized about 10% of your credit limit, and you have paid whatever amount which you have used from your credit limit on time. If you have not paid it on time and if you have paid it with delay, that also gets tracked negatively. So your credit score is going to get docked. You're going to get a negative score the more liberally you use credit, and if you're not sticking with your payment plans. If you have taken a personal loan for about a lakh and where you have an EMI of about 5,000, you have not managed to pay EMI for about 2 to 3 months, that also gets tracked by CIBIL. Now, combining all this information, they give a particular score to an individual. So any particular individual who has a score of 750 and above, 750 is considered as good. So all the banks would be looking at lending to individuals who have a credit score of 750 plus. So because of your lack of discipline when it comes to using the credit, if you have not paid it well, and if your score is less than 750, you approach a bank in order to take a housing loan, they're going to they might deny giving you a home loan, or if they agree to give you a home loan, they're going to give it to you at a premium rate. For example, an individual with a credit score of 825 might get a housing loan with at an interest rate of 7%. But another individual with a credit score of about 700, when he approaches the same bank, that bank might decide to give the property loan to him, but the loan interest rate is not going to be 7%. They might be charging you 8 to 8.5%. That additional 1 to 1.5% which they're going to be charging is because of the risk associated with you defaulting. And now you might be asking me as to what difference would 1 to 1.5% makes. Guys, I'm speaking about the property loan where the loan amount would be about 60 to 70 odd lakhs. Okay. And 1 to 1.5% will make hell lot of difference. That difference or the cost which you're going to be paying for low credit score would run into lakhs, not thousands, lakhs. So you need to ensure that you maintain a good credit score from day one after you are getting your credit card or loans. And it's good to have credit card. I'm not somebody who would advocate against it. As long as you use it intelligently, it's a good instrument to have. Some of the ways with which you can improve your credit score is pay your bills or loans on time. Credit inquiries, keep it to the minimum. Just because when you're browsing through the website, you saw an ad stating that ICICI is offering an Amazon Pay card, wherein you are going to get discount of about 5% on every retail purchase which you're making. Don't just go for the sake of the offers which they have. And just don't go on inquiring about credit cards or loans every now and then. Any credit inquiry can also be leading to negative scores in your credit scores. And percentage of credit card usage. If you have a limit of about 1 lakh rupees, ensure that on a monthly basis, you do not use more than 40% of that 1 lakh rupees. That is about 40,000. It has to be less than 40% because anything over and above 40% would also quantify as a negative parameter. Secured versus unsecured loan. If you have a property or a car loan, that's a secured loan. Your personal loan is a unsecured loan. And if you have only personal loans without any secured loan, that will also be a negative factor. And the last but not the least, you need to regularly review your credit score on the CIBIL portal every now and then. If you see any deviances or if you see something which actually is not in your favor, then you will have to go ahead and work with CIBIL in order to rectify your credit score. Extremely important concept, which you guys will have to be aware of if you have to take loans in the future. Any questions?
If we are not using any type of credit transactions,
yeah,
it's not necessary to check the CIBIL score, right?
Your CIBIL score is going to be 0 because they would not have anything to measure you against.
Oh, okay.
So if you don't have anything, then they can't measure you against anything. So it's better to have something in order to build a good credit score for yourself.
Okay.
For example, what I use is I use my credit card in order to make my grocery and other purchases. So the moment I do the transactions on my credit card, I immediately transfer money from my net banking to my credit card and close that particular transaction there.
Okay.
So that way I'm maintaining my credit score. At the same time, I do not carry any liability also.
Okay. So, but then I wait till the billing cycle and then pay.
You can. You see, that is up to the individual. As long as you wait until your billing cycle and pay the amount within the last payment date, that is completely fine. But what is not fine is the minimum amount. In addition to the total amount due, you would also have one more line there stating that the minimum amount due.
Yes, sir. From 2 months, I've been paying that only.
Then your credit score will get jacked. Plus, you are paying at an interest. What is the interest which you would be paying for the outstanding amount? You would do you know that?
3%, sir.
Per month.
Yes, sir. Yes, I know, sir.
Annually 36%. Who gives or who charges 36%? Or which asset will give you 36% kind of a return? Tell me.
So, but then once we clear the amount by the next following month,
yes,
will that interest be carried forwarded or what, sir?
No, that will be knocked off. If you are paying, for example, month 1 and month 2, if you have paid minimum amount due, so the next billing cycles, they are going to charge you interest. And in the third month, if you are clearing everything,
yes, sir.
Then end of the transaction. But you would have paid 6% of interest.
Yes, sir. Yes, sir.
On your outstanding. 6% is way too high, even for 2 months. So anything, and one thing which you will have to ensure while you're using credit card, never ever withdraw cash using your credit card.
Yes, sir. Once initially when I had received credit card, I didn't know that.
How did you get your credit card, by the way?
So my transactions are good, sir, and savings are
okay. So limit your credit card usages, and if you are doing any transactions, ensure you pay it completely and do not have minimum amount due.
Yes, sure.
So what if now that if you don't, our credit score is 0, then on what basis do they charge us the interest?
See, they are going to charge on your transactional. For example, if you have a salary account with them, okay. Now, for an individual to take a loan, there has to be a source of income, right? That source of income can be business income or salary income. The bank from where you have taken a loan, if that's the bank where you are getting your salary also credited, they would see that, okay, on a monthly basis, you are getting your salary on time. Then they're going to take that particular risk and they're going to offer you a personal loan or whatever loan which you might have opted for.
Okay, sir.
That's purely transactional basis. Or a bank where you are holding your SB account since ages. Your parents might have deposited money over a period of time and you are continuing that bank account. Even that bank might come forward to give you certain loans. That's purely transactional.
So one more thing. So you said like don't use 40% of whatever the
More
limit.
than 40% of your credit limit.
Yes, like if it is 5 lakhs limit, then for 40% of 5 lakhs we shouldn't use it, right? Sir?
That's right.
Okay.
But that 40% is also subject to another condition that you should be in a position to pay that particular amount in full before the next billing cycle.
Okay, sir. Okay.
Okay. Keep
Yes.
that also in mind.
Yes, sir, sure.
No minimum payment from now onwards for anybody for that matter.
Yes, sir, sure.
Because in my professional circle, I know quite a lot of people who have taken the loans, they have converted it into EMIs, or some people are paying minimum dues where the interest rates is way too high. All those things happen, but ensure you don't do it. That's a good way to start your career or your financial journey.
Sir, EMI in the sense, does it include the gadget EMI also, sir?
Yes, obviously that would also, because for example, if you are purchasing it from Amazon, they might give you a 0% interest. Okay,
Yes,
that's sort of an okay to have it, but my question would remain. So as to whether that gadget is actually important or not, or if you're like taking it for just aesthetic purpose, that's a different discussion to have.
Okay.
Any other questions on credit scores?
No, sir.
Stock tips. This is the last topic for today, I think. So how many of you received stock tips on your mobiles? Or receive calls from places like Indore or in certain cities of Madhya Pradesh, which offer to provide you stock tips? Anyone?
No, sir, I haven't received any.
No? Okay. I will just give you a hint. In case if you open Demat account, your information would be available online and you will be contacted. Now, there might be about 100 individuals who would have the Demat accounts. Give me 1 minute. We might have about 100 individuals who would have, or 100,000 individuals. So what these tip companies do is they take out your number from a public database or a purchased database. They start calling out everybody, stating that they are a stock tip provider, and they provide you good calls on a regular basis with which you can make money. Once they collate out of 100,000 people or 1 lakh people, 10,000 people might say that they are interested in order to avail a trial basis, wherein they are going to give about 5 days worth of trading calls free. Now, they are going to divide this 10,000 individuals into 2 groups, Group A and Group B. Now, for Group A, they are going to say, go ahead and purchase Reliance Industries today. Okay. Now, Group B, they're going to go ahead and say, sell it. Now, in market, there are 3 things which can happen. 1, prices might go up, prices might go down, or prices might be constant. Now, they are not going to select the companies where the volatility is on the lower side. They are going to select companies where the volatility is high. So there are only 2 possibilities of either prices moving up or moving down. Now, let's assume the price moved up. So 5,000 individuals who were in Group A, all of them who had received the buy call, they would be extremely happy with the service provided by this tip provider, stating that whatever they had promised, it is delivered. That is call number 1. Now, what they are going to do is, what the company would do is, they will take this 5,000 individuals, they would further divide it into 2 groups. 2,500, 2,500 each. So the same cycle applies for Group A. They will give you the buy, and Group B, they will give you the sell call. They are going to repeat it about 5 to 6 times or more than that, depending upon their trial period. Now, at the end of about 5 to 6 calls, they will be left out with a group of hardly about 30 to 40 people after eliminating everybody, or in fact more than that, but I'm just taking 40 to 50 people. Fair enough, who have seen 6 trading calls being provided by a stock tip provider, and all of it has worked in their favor. Now, what these guys would think is these guys are the market experts who will help me in making money, and they are going to be making the payment of about 10 to 15,000 rupees for taking the stock tips. 10 to 50, or even if I were to take 10,000 rupees over 40 individuals, that translates to close to about 4 lakh rupees of revenue for them. But in the backdrop, you see how these particular groups are being created and how they are playing with the teams in order while providing the stock tips. So it's not a calculate. It's not something which they are actually predicting. It's just working in their favor. So stock tips work in the same fashion in the real world as well, wherein they are going to give you incorrect stock tips, and these are the major forms of wealth destroyers. Do not subscribe for stock tips for your investment purpose, or else you are going to lose out your money and you are going to be crying over stock market being a wrong place for making investments. Any questions? That's the last topic for today from my end.
In Instagram, I had seen people posting, if you want to make money, please follow the such account.
Yeah. And after some point of time, they will ask you to make the payment in order to follow them.
Yes,
Yes, very much possible. There is another considerable factor also. There can be operators also in the market. For example, they might have purchased, for example, a small company where the share price is about 2 to 3 rupees. You can manipulate that particular share with cash of hardly about 40 to 50 lakh rupees. Any individual who has 40 to 50 lakh rupees, he can go ahead and grab a significant portion of the shares which are there for that particular company. And then he can come to Instagram or Twitter, and then he can start posting incorrect messages or luring messages stating that this stock is going to go up and go and grab it. And when they do that, whoever their followers are, they might go ahead and try to grab it. And when they do, the stock prices move up.
Yes.
And that's when these guys would go ahead and dump their shares in the market at a higher price. They will walk away with profits on their original investments. And the retail investors would be stuck at a higher rate. And they would not have anybody to sell to. It can work in both ways, either operator driven or stock tip providers. You will have to be careful about both.
Yes. So it's better to operate alone, I mean, in the investment part, right?
Start with your mutual fund investments. Okay. Learn the fundamental and the technical analysis associated with stocks, and then make your independent stock investments.
Yes. Oh.
And it doesn't matter whether you are 18 or whether you have PAN card or not. You can go ahead and purchase mutual funds. Yes, just speak to your financial planners, your family's financial planners. They will be able to help you out.
Okay.
Any questions? I have overshot my time by almost about 15 minutes. Apologies, Ajay. I had to cover this.
No. It's okay. Your students are gaining the knowledge. Okay.
So I'm open for any question which you guys have in all of this. This is something which I inculcate for parents who actually come to me for advice to start teaching their kids also about personal finance at an young age itself, which doesn't happen in our Indian culture for the time being.
Yes, sir.
So any questions which you guys have on any of the topics which you covered over the last 2 sessions?
No. Is it good like having credit cards in excessive numbers, sir?
No.
Okay.
Have 1 or maximum of 2 cards. What I use is for, I have a credit card with a limit of hardly about 40,000. Ajay, our HP Citibank card. So that's the only one which I use for my grocery and other related expenses. And I have a backup card with higher credit limit, which can come in handy for any of the emergency purposes.
Yes, sure.
Otherwise, stick to one or maximum of two. And second one is only for backup. One is for primary, and that too, not more than 40% of the credit limit needs to be used.
Yes, I have one with excess of limit.
Students, Raghu, for students, I think it's not necessary, right?
For students, though, definitely not. I don't see the need of having a credit card for students. So whatever I'm speaking about is in terms of once you grow out to be in qualified professionals, once you start making money for yourself. Because you are going to step into the corporate world in the near future. So you would require all this knowledge at that point of time.
Yes.
Excuse me, sir.
Yes, yes, please.
What is your opinion about investing in SIP?
Best way of creating long-term wealth.
Like we can start from now only, or should we wait till we start earning?
I have a daughter who is 8 years old, and her investments I started about a year back. And I still consider that to be late. I hope that answers your question, Natasha.
Okay, yes, sir.
Okay, now let me just give you one small example, okay, of how SIPs would work. Let's say you get a pocket money of about 500 or 1,000 rupees, okay? So let's calculate the future value of your 1,000 rupees, which you are going to be investing over a period of about 20 years. Okay, I'm going to take a nominal return of about 11% from the equity markets over a period of 20 years, where your investment is going to be 1,000 rupees. Okay, and the investment would start at the beginning of every month. A mere 1,000 rupees saved on a monthly basis can help you in creating almost about 8 lakh rupees worth of asset for you itself in 20 years. You change this 1,000 rupees to about 5,000 rupees. Anybody who is starting their career would earn no less than about 12 to 15,000 in this particular time. So out of which you can easily save about 5,000 rupees, and your career would also progress and your salary is also going to increase. But even if you were to limit your investments to SIPs of about 5,000 rupees, in 20 years, you would end up accumulating close to about 40 to 41 odd lakh rupees in your account, which can come in handy for either down payment or for your retirement or any other purpose for that particular matter. A mere 5,000 rupees invested over a period of 20 years would help you in accumulating this. Yes, Hitasha.
Sir, but then the inflation rate comes in, so like the
Yeah,
inflation
obviously.
happens.
Inflation will eat away at any point of time, whether you invest or you don't invest. Inflation would always come into the picture. But with the investments which you would be making, you will be better prepared to tackle the inflation at that point of time. So what I recommend is every year when you are, if you are saving about 5,000 rupees now, and next year, if you have a salary increment of about 15 to 20%, your investments of 5,000 rupees will also have to increase simultaneously. This year, if you are investing 5,000, next year you will have to take it to 6,000 rupees. Your savings will have to grow at the same proportion as your income. That way, you can easily beat inflation and create significant amount of wealth for yourself.
So you mean like this year if I'm investing how much ever, next year at least some percentage should be increased.
Yeah, increase it along with the raise in your income. That's the best way. Increase it along with the raise of income. That will be the ideal combination to work with.
Okay, sir.
Excuse me, sir.
Yes, Kiran.
So, what do you think about cryptocurrencies, sir? Like,
strict avoid for me. It's a strict avoid for me. Any currency, for example, Imagine, I was speaking about import and export business in the some time back, right? Now imagine cryptocurrencies becomes the norm, okay? And cryptocurrencies fluctuate by almost about 20 to 30% on a daily or a weekly basis. Imagine what would happen to the business of import and exports.
Yes, sir. But like from the initial stage, like we evolved using coins, papers, and now we are using digital currencies, sir.
Yes.
And what do you think? Like, how would cryptocurrency would affect this, sir? Like, what would be the chances
What
of?
is the base of this cryptocurrency? Tell me, which bank is regulating? Which government is regulating this?
Sir, even in the beginning stage, we thought that we won't be using more of digital currencies like Paytm and stuff, but we are using now, and won't we accept it in future, sir?
See, Paytm is nothing but your hard currency translated to digital currency. There is always a government which is backing it up to ensure that this currency is actually taken care of. The fluctuations are taken care of. It's just a digital mode. There is no other variation as such. But cryptocurrencies are a different world altogether. And that's something which, say, either any of the regulators are bringing it under their control. Until and unless it is brought under the SEBI control, or any regulator for that particular matter, I'm not going to be investing or advocating cryptocurrencies.
Okay,
it's
sir.
a strict avoid for me from my personal space.
Okay, sir. Thank you, sir.
You're welcome.
Paytm, PhonePe and all are just the medium for transactions. No, sir.
That's all. It's your hard cash which gets converted to digital. That's all.
Yes, sir.
Any other questions?
No, sir.
Anyone else?
Sir, even though there is no regulatory now controlling crypto, but still it is growing at such a good rate, no, sir?
Let it grow. So we have other instruments which we know, which we can understand and we can invest. Our objectives of retirement or our kids' education or house, anything for that particular matter, if those objectives and goals of ours can be taken care of with other asset categories, then I would choose those other asset categories in order to do my investment rather than investing in something which is evolving, which where there are no regulations, which I do not personally understand. So I would personally stay away from such investments.
Yes, thank you.
Okay, I think the question and answer session it's been done for today. Thank you, sir. Thank you very much. Thank you for enlightening all our students related to personal finance, to covering the ways of savings and investment, growth and diversity, also various options available in the market to save and grow funds, and throwing some light on inflation also. So there are a couple of subjects which covers this concept theoretically, but you gave life for the theory through your practical approach. So I hope students have connected their dots from what they have studied to what they have understood. Thank you, sir. Thank you very much. So I request Mamta to give a vote of thanks. Mamta?
Happy morning to all. I deem it is a great honor and privilege to propose the vote of thanks on this occasion. Firstly, I would like to thank our chief guest, Mr. N. Raghukumar, CFP, who despite his busy schedule has found time to grace this occasion and enlightened us with such interesting and inspirational information. I thank you, sir. I thank our respected principal, Professor Siraj Yuar Rahman, for his support in the seminar. I thank you, sir. I heartily thank the Vice Principal, Dr. Ajay R., for his contribution and encouragement. I thank you, sir. I would also like to thank our beloved lecturers for their moral support and guidance. I thank you, teachers. Lastly, I thank all my friends for your cooperation in making this seminar a grand success. Once again, I thank everyone to support in this seminar. Thank you, one and all.
I would be extremely happy if you guys actually implement whatever you guys have learned so far in these 2 sessions in your personal life and take it forward. That would be a great achievement in itself for me if you inculcate that.
Yes, sure, sir.
Thank you. Thank you, everyone. Thanks a lot, Ajay.
Thank you, Raghu, and all. Yes.